Hey everyone, in this video I'm going to compare Plug Power stock and DraftKings stock and answer which one I think is the better growth stock to buy today. Now you might be saying, well, Plug Power and DraftKings operate in different industries and they're different companies. This wouldn't be an apples to apples comparison, and you would be right. But the reason I'm comparing these two growth stocks is because there are investors out there. Some of you that are watching might be one of those investors that are asking themselves, which one of these two stocks should I buy right now? And you're not really thinking about comparing two stocks in the same industry. You're specifically thinking about comparing DraftKings and Plug Power, and you want to know which one I think is the better buy. So that's why I'm going to do this video. And when we're looking at these financial metrics, we're going to realize that these two companies are similar when we look at financial metrics as well. So that's going to be an interesting thought experiment to consider. So I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. Let's jump right into this comparison, starting with looking at these two companies' revenue. And what you'll notice is Plug Power and DraftKings have been growing revenue nicely over the last several years. Plug Power has increased its revenue from a little bit over flat up to 198 million. Meanwhile, DraftKings has increased its revenue from a little under 400 million in a quarter all the way up close to 800 million in a quarter, 789 million. And let me show you one interesting thing about DraftKings in the gaming industry that it operates. So the global sports betting industry reached $242 billion in 2022. But more specifically for DraftKings, the size of the global online gambling and betting industry amounted to $61.5 billion in 2021. And according to Statista, this is expected to rise to $114 billion by 2028, representing an increase of about 86%. So this is a growth industry, and DraftKings is still in the early stages of capturing this billions, several $1 billion and close to $100 billion market opportunity. The next thing I wanted to compare these two growth stocks on is operating income. And look, what I mentioned in the beginning of the video when I said these two are more similar than we think, look at how close their operating income is. They're both losing money on the bottom line. DraftKings lost 286 million in their most recent quarter. Meanwhile, Plug Power lost 271 million in their most recent quarter. Now, another interesting thing to consider is that DraftKings, if you look at the bottoms here, it's a cyclical business to be sure, right? The football season is the most popular season for DraftKings, and so it's going to have boom times during the NFL season, and then the slower sports seasons is going to have a slower revenue generation, right? So you could see the quarterly revenue, looking at just the bottoms here, it's been higher and higher and higher, so it's moving in the right direction in terms of its operating income. It's reducing those losses on the bottom line. Meanwhile, Plug Power is going in the wrong direction. Its operating income just keeps getting worse and worse and worse, culminating in the 270 million quarterly loss in the most recent quarter. The next thing to highlight between these two is their cash flow from operations. And you could see around 2021, they were similar in terms of how much cash they were losing. They were both losing cash flow from operations every quarter. But DraftKings has moved in the right direction since about mid-2022. It's been improving its cash flow from operations and culminating in another positive quarter of cash flow from operations of 145 million. Meanwhile, Plug Power, again, just moving in the wrong direction, losing 238 million in its most recent quarter. So one of the more interesting things I look at when I'm considering an investment in a company, especially an investment in a growth stock, is total long-term assets. All else being equal, I prefer companies with lower assets with lower asset growth, because that shows me that the company can grow without needing to spend money adding assets, right? Think of a restaurant. Would you rather invest in a restaurant that generates 100 million in revenue from one location, or a restaurant that generates 100 million in revenue from 100 locations? Clearly, the one with one location is doing a better job running the business, right? One location generating 100 million. That means if it opens another location, it will likely generate significant revenue as well. And the opportunity for growth is much larger than the other business. So for that reason, I prefer companies, all else being equal, with lower assets. And DraftKings does have lower total long-term assets at 1.9 billion compared to 3.2 billion for Plug Power. 1.9 billion in assets compared to 3.2 billion. And if I go back to revenue, DraftKings generated more revenue, 790 million in the most recent quarter compared to 200 million for Plug Power, even though DraftKings had much lower assets, more than $1.3 billion in fewer long-term assets. So I like that. I prefer DraftKings in that comparison there. I also want to look at long-term debt, and in this comparison, DraftKings has more long-term debt at 1.25 billion compared to Plug Power at 198 million. And all else being equal, for a growth stock in early stage growth, I prefer the company with lower long-term debt. So in this case, Plug Power is in the more advantageous position. The next thing I want to look at is average diluted shares outstanding. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. So with that being said, let's look at the actual figures here. So Plug Power has increased its shares outstanding from a little over 400 million all the way up to 599 million, a close to 50% increase in shares outstanding. DraftKings too has diluted shareholders, increasing shares outstanding from about 390 million all the way up to 464 million. But in this case, it looks like Plug Power is diluting shareholders a little bit more than DraftKings. And given that Plug Power is still losing more money on the bottom line and still generating significantly negative cash flow from operations, I suspect that Plug Power will continue to dilute shareholders more than DraftKings is expected to dilute shareholders. And finally, I wanted to look at valuation, and for these two, I chose to use the forward price to sales ratio. And boy, how things have changed for Plug Power and DraftKings. In 2021 and 2022, Plug Power was way more expensive according to this metric, right? Plug Power was trading at one point at a forward price to sales of 45, while DraftKings was less than 15, so Plug Power was more than 3 times as expensive. Fast forward to today, and DraftKings is almost 4 times as expensive as Plug Power. So they flipped, and DraftKings is now the more expensive stock at a forward price to sales of 3.9 compared to 1.172 for Plug Power. Still, even though DraftKings is more expensive, if I was to pick between these two growth stocks to buy today, I would pick DraftKings. DraftKings would be my choice between these two as the better growth stock to buy. Did you know that over 90% of the views I get on my channel are from individuals that are not yet subscribed? To help keep this channel alive, let's try and get 10% of you that are not yet subscribed to click that button. Remember, the YouTube channel cannot survive without the support of viewers like you.